and welcome to good evening, investors, and welcome to another edition of Learn, Grow, Invest Club. Tonight we have two of our very own giving some information on tips and tricks, their ideas. Now, let me just make sure everybody knows this is not investment advice. We are not giving you official investment advice. Please ensure that you speak to your advisor if you would like investment advice. To my, left, we have GK, who is an IT specialist by day and Warren Buffett impersonator by night. He spends a lot of time making sure, combing through the books and making sure that he is very, very well versed on all of the investment terminologies to try and share and break down for the less well-read. To my right, we have Andre, who is a research analyst by day. And I guess I don't really know what Andre does by night, but I should be handing over to them so that they can give you some of their tips and tricks in investing. Hello, gentlemen.
Hi, Lisa.
Hey, how you doing, Lisa?
GK.
Yeah, what's up, Andre?
Yeah, so the meat of the matter is to discuss the stock picks that we're watching for 2021.
Well, before we get started there, GK is going to open in prayer for us.
As we customarily do, we're gonna open in prayer. So, Father God, we come to you again with thanksgiving for another meeting that we're able to present our views and opinions about all things investing that we see, with specifics to the current market, the Jamaican market that most of our audience is in, and with the expectation as we expand and take it to other markets as well. We give thanks for the blessings of protection over our families, everyone that is here and everyone that is a part of our team or group, and the persons online as well. And we ask for protection of their families as well. Let the information that is about to be discussed be well received by everyone, so that they are able to be more informed to then further be able to make a credible decision in any of the discussion points that we will be undertaking tonight. In your precious name we pray. Amen.
Amen. Thank you, GK. Take it away, Andre.
Okay, so I think that we're speaking about like the 5 main picks that we want to discuss today, but to be honest, I kind of have my eyes on, a lot of stocks this year, because that COVID kind of pushed prices down and the bargains left, right, and center. So, but you can only choose so much, So I guess before I probably get into my, like the 5 top ones that I'm actively monitoring and so forth, I probably would want to start off with some lesser ones that I'm less actively monitoring. I think the first one on my list would be Carreras Cement. What I like about Carreras Cement is that it's basically the sole manufacturer of cement locally, and basically I think their performance can be directly tied to the performance of the cement industry. Recently, Stacking would have reported that from July to September, the construction sector would have grown by 7%. And year to date, Carreras Cement has been performing greatly. This has been boosted by strong growth in revenues, and they're basically getting the debt, they're getting the finance costs under control, because back then the earnings have been plagued by the finance costs. But I noticed that for the year-to-date period ended September 2020, they kind of got the finance costs under control, and as such, they reported stronger profits. For the 9 months ended September, they actually posted 2.2 billion and this compares to 1.5 billion for the prior period. I mean, revenue is up 11.8%, and that's double-digit growth amidst a pandemic. So I have my eyes on Carib Cement. I think it's kind of trading at a relatively high PE, so that's why it's not really one of the top ones. The PE that it's trading at right now should be around 20 times, and yeah, they're basically under the manufacturing industry, and that their manufacturing industry PE have been averaging around 22 times. It's still a premium, it's still a discount relative to the sector, but I mean, during these times, I find lower PEs, stocks with lower PEs to be more attractive, in my opinion.
I'd have to give an agreement there. For in truth, so from what I'm looking at, yeah, you're right. The PE currently sits at, as of today, from what I'm seeing, 2021, 20.21. Yeah, the price to book based on the calculation of itself is about is 4.86 times over. So the average book value per share currently is sitting at 12.43. I mean, it is a bit high, but the truth of the matter is actually the price was coming down a bit earlier on in the year, and that $58.50 price was actually a nice little sweet spot at that point, because it was a really low PE. There the PE at that time was down to 20, nearly about 20 flat, So, but go ahead.
So I mean, you touched the price to book being, what did you say? It was around 4.8.
Yeah, for the current over, has it at 4.86 times over. So the current book value standing is 12.43.
Yeah, so I mean, I figure that high return on equity is basically, as a result. Sorry, the high price to book is basically as a result of the high return on equity. Because looking here, they have been generating a return on equity of about 24% based on its trailing net income, and that's a premium to the main market manufacturing average of 11.8. So I mean, I figured that the main fact that they have a high PE is basically warranted, or a high price to book, I should say, is warranted because of the strong return on equity that it has.
And also expected too with the housing market, with the market of itself as well. Plus, they've got good stuff going on qualitatively in the background. You've got that venture that they're on to crush the tires and turn them into I don't know what exactly they're doing, but they're doing the recycling of the tires. That actually has big initiative as well too, that gets off the ground.
And what I actually like about them is that they're actually great at their the containment of costs. So basically the year-to-date improvement, or the year-to-date uptick in revenue, has been bolstered by growing volume sold, and normally with higher revenues and so forth, they have been able to actually keep their expenses under control. They've been achieving operational efficiencies, and it shows that they're reaping the fruits of investments past and so forth. So I'm definitely looking at it, and basically the local housing market has been resilient.
Yes, massively.
Rent, like the rental prices would probably have been coming down a bit because of COVID, but as far as I've learned, house sales have been still been attractive. So the mere fact that it's like an incentive for investors to continue to be invest in properties, to buy houses and continue with the development, and that Carib Cement will properly benefit from that. So that's why I have Carib Cement on my watch list.
Well, I'll add one more thing, and for the side of the value, is a value company as well too. We must not forget that they've been around, and for the same period that you're talking about as well too, there has been good increase in shareholder equity, moving from 7.9 billion in that unaudited quarter to 10.5 billion. So that as well bodes well, strongly capitalized on the balance sheet side. So yeah, most definitely,
And for the longest while, they actually had accumulated losses on the books. But given proper management and cost containment efforts, growth in revenues, they will actually now have accumulated profits. They're able to boast about having retained earnings. I mean, that's definitely kudos to them and the management team.
That's extremely true.
Yeah.
So to bring it down to the level of the rest of us, they weren't doing well for a really long time, and then you guys combed through the financials and realized that they did really well for 2020.
Yes, in 2020 they've definitely been doing well.
In spite of a pandemic.
In spite of a pandemic, I heard Andre say something about rent going down. Please tell me, where are these places where the rent is going down? Because I need to go check that out.
That's based on information from the HAJ. So I mean, we're all being plagued by high rent prices, especially in Kingston. But according to data from HAJ, they've been saying rent has kind of been. It hasn't been displaying the same performance as house sale prices.
Oh, so it's not going down, it's just not going up as much in comparison to the sale of houses.
Basically, yeah.
Oh,
so there's a contrast in terms of, yeah.
Because I mean, the construction boom, if you're speaking from a layman's term, the construction boom, you can see everywhere you drive past, this, that, and the other, there's some construction taking place.
Yeah,
and that would, of course, indicate that obviously people buying cement. But if we're breaking it down, what am I looking for? If I'm looking at the financials, I'm not savvy, I'm not familiar with the industry. What am I to look for with a company like this one?
Okay, so like with a company like Carreras Cement, I like to look at, the price multiples to show that, for example, I like to ensure that I'm buying the stock at a good price. I normally compare it to the overall market, or I compare it to, the sector or the industry within which it operates, and, compare the PE, the price to book, and things like that to
So what sector would CCC fall into? What industry markets?
So it falls under the industry market because, they're manufacturers of cement. They don't have any direct competitors because they're mainly the sole manufacturers. So the best one would want to compare their price multiples to the manufacturing industry average, or you could go ahead and compare with the overall market. But if you want to kind of fine tune it, you'd probably it would be best to do it to the manufacturing industry.
Okay.
So I also like to check for the revenue performance over a period of years. So let's say 5 years, and I also follow the net profit performance. So once I like to look for growth in revenues, as well as the pace at which revenue is growing.
So we're looking at the revenues for the last 5 years.
Yeah, that's where I like to start, so I can get a broad view of the trend. The revenue trend.
How we know last year not just a fluke? If they were doing badly before and then they're just suddenly doing well in 2020, how do we know that 2020 is not a fluke?
That's why when you put 5 years of charting, as we've normally shown in other meetings, it's hard to hide trend. It's there on a chart. Once you put it up there, it's either going up or it's going down or it's bouncing around the place. One of those things is gonna pop out at you straight.
Yeah,
and good companies, even if they're not always going up, they do it in a nice progressive manner. So even if they taper off a little bit, they still bounce back the next year to continue rising. Well-managed companies trend upward in where they're trending upward.
Yeah, so that's why very important. That's why I like to look at the 5-year trend. So, let's say 2018 was a fluke, and then we see strong revenue performance, strong profitability performance of 2019. And then, let's say that was led by a one-off gain. They probably sold an asset, and that's why profits went up. I mean, I don't want to buy into the stock because of that, and then for the 2020 financial year it goes down, and then I lose capital. So that's why I like to look at the 5-year trend as well.
Okay.
So other things that I like to look at, other metrics. So once I've assessed the revenue and the profitability trends and things like that, I like to check out the performance, the margins. So what I normally find to be attractive is once you're seeing improvement in the company's gross profit margin and like the net profit margin, things like that. That shows that the company is increasing its operational efficiencies. So those are like the key things that I like to look out for.
On my side, I add the operating profit margin as well. For my side, that's actually very important for me because operating profit margins tell you exactly how they're handling their expenses and how they're handling all of those what is called SG&A, which is selling, general and administrative expenses. So things that fall under management fees, salaries, etc. Those things bite into net profit extremely badly by the time before we even get down to taxation. So you want to pay keen attention. Additionally, too, your operating profit margin is the one indicator which actually you can use as the main metric to actually value any company out of any industry. It's the one that it looks across the board at anything versus well, at least that's what I read, versus your gross profit margin, which is a more higher metric that doesn't take into account what the company's management is actually doing about to manage the company.
So how do I know if the company management good?
You can't. Okay, so let me give a quick example. You can't start off with $1 billion in revenue, and by the time you reach to your net profit, all you have is, say, for instance, about $30 million in net profit. Something went drastically wrong along the line of that income statement, profit and loss statement, and most of the time, when you check, it normally went wrong on the operating expenses side. That's where it went.
Okay.
And it's especially good when you're able to compare like your operating margin against peer companies. As I said, with the case with Carreras, we don't really have any direct competitor for them. But I mean, if let's say there were actually other cement manufacturers in Jamaica, you would be able to understand what the cost dynamics of the industry is when you compare the respective operating margins and things like that, the respective gross margins or the expense to sales ratios and things like that. And that's how you can properly assess how good management is at doing in terms of containing expenses. So that's one way to look at it.
I'll do a plug too. I'll post it, I guess, later on, but all of the ratios and others that we have mentioned here was also done very nicely in depth by Simon a couple of weeks ago, where he broke down the main types of ratios that you would be looking for in terms of solvency, profitability. I can't remember the third one, but solvency and profitability are the main ones that stand out. So yeah, definitely, I'll do a repost of that there.
Yeah.
Definitely want to bookmark that.
Yeah, it's definitely important to look at like your solvency and your liquidity ratio. So you want to look at your cash ratio, your current ratio, your interest coverage ratio, things like that, to ensure that the company is able to demonstrate a strong ability to operate as a going concern.
Yeah. All right, so to compliment you, Andre, on that one, I am not in the cement part, but I can take it still on real estate. My one on the side there that I have been looking at for a while now is Kingston Property. This year has been interesting about Kingston Property as well. If anybody has watched what they did, so they're actually looking to go back into I believe it's the US market. They're thinking to go back into again. Don't quote me wrong, but I know they're planning. They were looking at going back into a market that they had exited. But from the fundamental side, their performance, their end of year performance, because their year ended for No, well, they haven't put out their end of year performance for 2020 as yet. But on the 2019 performance, they went in heavily capitalized from before. Balance sheet wise, they grew shareholders' equity by about 100%. It was 14 million in the, and this is in US dollars, by the way. It says 14 million in 2018, 30.3 million in 2019. And then in the liability side, they only slightly grew that liability section from 8.8 to 9.6. And then when we move over quickly to revenue, based on what they were doing in terms of moving out of non-performing areas in terms of the real estate market into performing ones, they ended with a solid year in cash flow. Their year for 2019 ended with 15 million US in cash flow versus only 1 million in 2018. Now, for me, we can take an easy look on what would have happened for all of the quarters so far that are listed in there. And as the value invest in me, I go by the years. I love the yearly performance to get that trend, that 5-year performance there. They have been looking phenomenal, and based on what they said they're planning to do for this year for 2021, and also following on the back of exactly what we've been discussing about the real estate market, I want to think that we should pay some attention to them. That good things might be coming in terms of what they do. And especially if we haven't gotten their 2020 results as yet. So that is coming up shortly because their financial year ends in December. So we're in January now. So by about February it should be out. Based on when they released their 2019 one in February 28th. And so it's either end of February or about the start of March. Their financials are coming out for the year. Might want to keep an eye on them still.
Yeah, I mean they're definitely one of the good performing companies in the real estate sector. They have, at a glance at the price multiples, they have relatively favorable ratios, and that they intend to come out with an IPO.
That too, more capital. Yep.
Yeah, so there's more capital. They can continue to grow their balance sheet and continue to make moves in the real estate space. So that's definitely a good one too that we can keep our eyes on. Yeah. Another one that I kind of have my eyes on would definitely have to be Wickham Wind Farm. There's a lot of opportunities on the horizon with respect to the clean energy and the renewable energy space.
Yep.
One thing that I think Wickham would definitely be poised to benefit from is should the government invite for bid proposals to increase the electricity produced to the grid, clean energy, I should say. I definitely think. Yeah, I think Wickham will be definitely a listed company. They'll be definitely properly positioned to submit a proposal and should definitely be one of the top companies that would qualify to receive that contract. Right now, Wickham trades at a PE of around 14 times. So it basically trades at a low PE. It's been trading at a low PE for quite some time now. I think basically the reason why investors has priced it at a PE of 14 times is basically currently there's not much room for growth in revenues for Wickham because its revenues are directly linked to the business that they get from JPS, and with that comes significant counterparty risks because if there's a downturn in JPS's operations, there's a downturn in Wickham's operations. That's the kind of risks that you inherit with large contracts that are exposed to large commercial entities where you have significant counterparty exposure risks. But I'm definitely keeping my eye on it because I think they can generate stronger profits by implementing more prudent cost containment measures. That's how they would be able to improve their profitability. So that's definitely one thing I'm watching for with Wickham. The JC managing director Ms. Marlene Street Forest, she was quoted as saying that there's an opportunity for significant capital financing in the disruptive sector space. And basically right now, there are only 3 companies operating in that space, and it would be, the clean energy companies like your MPC and your Wickham, as well as Mailpac. So I definitely have Wickham on my radar.
Well, I'm going to add to you.
Them from the sideline.
Well, I will add to you to make sweeten the pot. One should not scoff at their earnings yield still, because it's at 7%.
Mm-hmm.
It has been a constant 7% in terms of their earnings yield potential. So, and definitely when it comes to their price to book value, it's not that far over still. It's actually just about 2.1 times, but their PE, as you rightfully said, is actually pretty low, 14.11 in based on where they fall in. And also they standardly have active trading nearly every day over 1 million units. Like literally, people like that stock, regardless of the fact of its movement of price. They know. For me personally, I love Wickham. Why do I love Wickham? Because from the get-go, they're my dark horse for one reason, and it's the long-term factor. You see, when the government finally, or when the license, the JPS license is finally up in 2027, Wickham stands to be the big gain in that, because if you remember the prospectus and we check out everything about this company, this is the sole company that has the ability to go into any form of renewable energy. They've already got wind farms that are set up, and they can go further in the island where they see the ability to set them up favorably. They also have the ability to set up solar farms, which they've already done that already as well too in Jamaica, and set up more where it is feasible to do so. And they have other farms that they can explore. They can explore hydroelectric. They can also explore one of the ones that is done out in Europe, which is actually big, which is underwater hydro, in which they basically put the turbine under the sea. It says deep water turbines, basically. You've got massive potential for Wickham as far as I'm concerned. So for sure, definitely.
I definitely agree. And I mean, you touched on the comparative multiples, like in terms of the PE and the price to book. Looking here, their return on equity is also a premium to peer companies. I mean, there are not much peer companies, but they have a strong return on equity of 14.9%, which when you compare it to the other category as listed on the JSE, that sector is averaging 12.3%. So I mean, the return on equity is a premium to the best key peers that we can find. So, and it's a liquid stock. I definitely like to trade liquid stocks because sometimes while the company's financials might seem stable and attractive, it's not. One wouldn't want to buy into a stock that once it's grown into its fair value, or what you deem to be the fair value of the stock, you have difficulties getting out. So Wickham it's a liquid stock. It's not tightly held, by the top 10 shareholders. So it's definitely an attractive stock, and I'm watching them.
Well, I'm gonna add to it as well too. I've charted the 3 years for them, and they have gladly given their financials for their 2020 year, which ended in March. And coming out of my numbers, you got great gross profit margin, great operating profit margin. Gross profit margin is in the high 60s, operating profit margin in the high 50s. They've capital, and funny enough, they're capitalized already. They have good free cash flow, as you rightfully said, with the ROE. So ROE in a combination with good free cash flow, excellent company to be looking at based on the profitability matrix of companies, right? You want high free cash flow in conjunction with high return on equity. So most definitely, and that's just on the profitability side. On the balance sheet side, again, they also did a much better year in 2020 than any of than previous years, with the exception of 2019. They actually got better in 2019, and they maintained it in 2020, where they have a high cash ratio, a high quick ratio, and a current ratio as well too, among the other ones that are there. So most definitely grew the equity as well too. They grew stockholder equity as well pretty nicely, by about 19% in terms of the change from 2018 to 2019. So yeah, good company in all right, and good things to come for them for sure if they keep managing themselves just the same way later on down in the future for the future.
Yeah, I definitely agree.
Yes. So well, for mine, well, the next one I'm gonna have is definitely this is completely an income and dividend company. So that I'm gonna pick up here. It's gonna be Carreras. And I'm gonna pick this one because if you've ever looked at Carreras, not even 5 years, you can go as far back as 10 years. Carreras has not missed the mark of being managed really well. Some things to look on about Carreras is what's gonna happen with the upcoming legislation between them and the government of Jamaica in terms of them wanting to move to that standard World Health Organization standard, which means going after cigarettes and getting them out of bars. We've already had the other measures that are taken. However, something to note is that Carreras started to pivot in a way that I'm watching closely, and that is, we already know the cigarettes are not manufactured here; they're only distributed here, right?
Yeah, correct.
They started to pivot in terms of what's the next biggest thing that Jamaicans or Jamaica deals with in terms of when it comes to smoking. It is rolling papers, and we saw them recently move into the rolling papers and the distribution of lighters. More than likely, that's an area, and it would be an area where, especially lighters serve multiple functions and purposes. So it doesn't necessarily have to be taking a hit like that. But even still, we should also remember that Carreras is a serious cash cow for the government in terms of revenue, of a revenue generator, because in bringing in those cigarettes, etc., at the ports, the taxes that they have to pay, etc., the fees, they are a solid revenue earner for the government. So it's going to be interesting to see what they do, how they're going to be, and how they pivot, or how the government is going to try and curtail them, because you can't just lop them off like that. And standardly, they pay a high dividend every year, every single year. Like I have them currently. Last year's dividend for them, the dividend yield for them last year. 1 second, let me quickly bring it up because I had it. Dividend yield last year for them was 8.86%. What was the inflation rate of Jamaica? Jamaica's point-to-point inflation rate as of 2020 was running around. They had to say it was like worst case 6.3, but it was really around 5 something. You're getting a stock that is a company that is giving you a dividend yield of 8.86%. Like that's just start alone, and then if we move over to the fact of their earnings yield potential is 10%. I mean, flat out, as a value stock, yeah, I will continue to watch them, and because they're just well managed. They take all of the boxes, and I'm sure when you get over to your side, to the side of when we talk about return on equity, etc., they blow that out the water everywhere.
What's the figure? Are you seeing? What's the figure that you're seeing for their return on equity?
Bringing it up now. 1 second. So return on equity for Carreras for their 2020, it sits at ROE sits at, and this is wild, it's 202.
Yeah, that's why I asked. Their return on equity, is amazing. I mean, the overall market average return on equity is 19 times, and they're doing 202. So that's why,
and 202 is not even a one-off. That has been the standard since in March 2014. They've been high 90s. In 2013 was 177. In March 2019 it was 255. They are phenomenal. They take all my boxes. In that free cash flow is up at 33%. I mean, they and just a new metric I just saw come on for them recently was their interest expense ratio, which for me is very important. It's currently being calculated, and somebody might want to check it for me who's more seasoned. I currently have it at 283, which is extremely high, right? Operating profit is a high 33%, gross profit margin at 49%. This company does it. It does it as value and also as you know the long term for income as well.
Yeah, definitely. So to like the income investors, I think Carreras is definitely like a top stock for consideration where dividend is concerned, because I mean you mentioned a dividend yield of around 8%. This compares to a market that's averaging, closer to 1%, 2%. And
Yeah.
not only are you getting capital appreciation from Carreras, but you're also benefiting from income, where, as you mentioned, their dividend yield is in excess of inflation, because the BOJ has been targeting an inflation rate of between 4 to 6%. Carreras is
That's
doing
correct.
so. What you see with the pandemic is that the point-to-point movement in the price, or the 12-month change, we see Carreras has actually moved from $8 to around 7.15 as at Friday. So
Right.
what the pandemic has done, it has made Carreras more attractive, because when you're buying in at that lower price, you're able to capitalize on a much higher dividend yield, because based on the company's performance since the pandemic has started, it has mostly demonstrated resilience. So I mean that goes to show that Carreras is definitely one of the good stocks out there.
Yeah.
I
Hey
actually,
guys, we're hearing some small feedback. I think it's from your side, Andre.
yeah. Okay, so the price to earnings ratio basically shows, it's basically calculated as your the price that you're paying for the stock divided by the EPS. So normally the EPS is calculated over the last 4 quarters, which in that respect would be it would be called the trailing EPS, or if it's just for the EPS for the last financial year, it's the let us call it EPS. So it's a important metric that investors like to use to basically determine if they're overpaying for a stock. Because while a company will be good and have good financials, you don't want to overpay for it. So the price to earnings ratio is definitely a good metric to use. And the way how it's normally used, it's compared against the overall market, or it's compared against key peers and so forth. It's one of many valuation techniques that one can use in valuing a stock and determining the fair price of the stock. Why I like the PE is that it's definitely one of the most popular ones, and it gives you it's a simple one.
Yeah.
It's for any investor that wants. You don't have to do any mathematical calculation and nothing like when you compare to, for example, a discounted cash flow method of valuation or a Gordon growth model, things like that. The average investor probably won't know how to calculate all of that, really. So P is definitely a much simpler and effective tool that one can use to aid in investment decisions.
True. Very true.
Um,
I like to add. I put the PE together with the price to book value, and that's what gives me the what I call my margin of safety. So the price to book value is the market price divided by the book value of the company. The book value of the company is calculated on the actual company's performance. Financial statements is coming out of the balance sheet. So when you put that together, you get a number, or you multiply the two together, you get a number, and that basically gives me my foundation to start looking at a particular company. So I like companies that have very high margin of safety. That means that the threshold that I'm starting at is anything at or below the number of 22.5 when you put the PE ratio and the price to book value together. So I mean, it's a good place to start as well too, if you're just getting started, and you want to purchase something that you can have some level of security in terms of understanding you can watch the price flow, and you won't have to worry about your money kind of going down most of the time. You know, marginal safety is a good place to start.
Yeah, definitely a useful metric to employ. And just to further add to you know, the benefits of using the PE. What the PE does, it allows you to assess like the demand for a stock. So you know that once a stock is trading at a high PE, that shows that there are a lot of buyers that buying the stock at higher and higher prices. So sometimes a higher PE is warranted when a company displays strong growth potential, but sometimes, you know, the market could be misled by the company's financial statements and so forth, you know, overstating the growth potential for the stock, and they're buying it at a higher price. So in a case like this, you know, one would want to sell the stock. If you think the stock that you're holding is probably at a PE that is much higher than where you see it headed into over, let's say, the short or medium term, that gives a good indication of, you know, good suitable prices that you can sell the stock at. So that's one of the uses of the price to earnings ratio.
Yeah.
Okay, so so just to get into, like, you know, my one that I'm definitely watching now, not the top five. I want to talk about that I kind of mentioned briefly earlier, and that is Mailpac.
Yeah.
For the longest while, I've been bullish on Mailpac. For the longest while, I think it was undervalued. It was trading at low PEs, and I mean, you know, quarter over quarter, the company has been blowing, you know, estimates. When I would calculate estimates, saying, all right, this is what I think it will perform for the quarter over a period of a specific period of time, it does better. And then one more thing that I like about Mailpac is that it generates a lot of cash. So they also have equity. They generate a lot of cash and they have high return on equity. So that allows them to be properly positioned to also be a dividend stock. So I mean at the moment, but I mean, when you have the perfect mix of a company that displays good dividend potential as well as being a growth stock, I find that combination very attractive. So basically, Mailpac has rallied recently. Over the last 12 months, like from a point-to-point standpoint, Mailpac has rallied by 75%, around 75%. So basically, around this time in 2019, Mailpac was around 210. And now Mailpac is trading at around 370, 380.
Yeah.
But when it was trading at 210, that would have effectively worked out to be a price to earnings ratio of about 12 times. And this is being compared to a market that's averaging 17, 18 times in a pandemic. So that just shows that the stock was very undervalued. It seems the market saw that, and there's been a lot of energy, a lot of demand for Mailpac, and that caused Mailpac to rally recently. So now it's actually at a PE of 21 times. So one might ask, do you still buy or do you sell? I believe that decision is based on your calculations or your assessment of the company. Right now, I'm more inclined to hold Mailpac as I'm excited to see what they have in the future. I'm excited to see, you know, the growth potential, any increases in dividends, things like that, because we only have Mailpac. The amalgamation of Mailpac local and the other subsidiaries was only recent. So we only have information for the last 2 financial years, if memory serves me correctly. So we can only calculate information for 2018 financial year and the 2019 financial year. So we're unable to assess the trend, but so far they've been doing very well. I mean, according to my calculations for the 2019 financial year, they had profits. They generated net profits of 289 million on revenues of 1.2 billion. So this is basically a net margin of 23.5%. So now, for the 9 months ended September 2020, they have exceeded the revenues for the 2019 financial year as well as profits. Well, no, they're basically on par with revenue for the 2019 financial year. For year to date period, they did 1.2 billion in revenues, and their net profit is 238 million, which compares to 289 for the 2019 financial year. Looking at other ratios such as the the liquidity ratios, the debt ratios, the debt equity ratio is like 4%.
Right.
The key ratios that you look at are very attractive, and when you look at the return on equity, it's 82%. As I would have mentioned earlier, the overall market is averaging like around 14%. So Mailpac is properly positioned to pay attractive dividends. So they declared dividends twice for the 2019 financial year. They did 5 cents in July and they did 4 cents in October. So let's say you were buying when the price was 2. Your dividend yield would have been around 4%. So it's not a Carreras, but it's definitely a premium when compared to the overall market. So right now, prices are like 360, 380. The dividend yield is 2.4%, which is still a good dividend yield. And, assuming that they're able to continue to grow profits and increase market share and ultimately grow their revenues more, dividend is likely to increase going forward. Because in July, they basically matched the dividend. They haven't decreased it, and we're yet to find out how often they plan to declare dividends. We don't know if it will be semi-annually or quarterly. So we'll just have to watch and see. Hopefully they entertain the thought of doing it on a quarterly basis and position the stock to be a good dividend stock that would lend support to increasing capital.
We need to check something. So I'm definitely hearing the feedback in your speakers. I'm not sure coming through from the mic. So Jeremy was asking if you need to reconnect or check that check the settings on the mic. I think it's when you click the gear under the cam mic setting and go audio, see if the echo cancellation and other stuff is locked off. Because when you're talking, we're getting that feedback. I'm not getting it now though. Yeah, it sounds it's better now.
Was checked.
Oh, it is. Oh, it's still there then. So Jeremy was asking then if you could just drop off and reconnect back again quickly. If you could just do that.
Okay, let me try.
Because so I'll just hold the fort until you get back. I'm gonna stay on Mailpac because I got some stuff that I'm gonna talk. So when you get back in, I'll recap.
All right, no problem.
All right, cool. All right, guys. So for the Mailpac side, and you saw me smile. Because in truth, so I have for Mailpac's earnings yield not bad as again. Current earnings yield potential 4.43% as at today, 27th of January. It was better at the 4th of January, which it was at about 6%. As we are in 2021, no dividends yet, but the dividend yield for 2020 was 3.24%. Also not bad based on what we're seeing in the metric that, at least the metric that I'm looking at. I hold the inflation rate very close to me, point to point inflation, etc. So companies doing at above, you definitely want to be looking at it. Additionally, too, we will remember that Mailpac, coming out of going into the pandemic, this entire situation favors them. Andrew is back, so let me hear how you're sounding.
Yeah, hopefully this is better.
Much better. Yeah, much better. So I was just talking about the earnings. The earnings yield. The earnings yield is actually as to date is currently at 4.4%. Was a bit better at the start of the year at 6%, but that is just genuinely due to the fact that the price has started to move. And the truth about it is that the entire climate of what we're in currently, the whole digital movement of shopping, just favors Mailpac. You know what actually is more than likely going to be big for them going long term though, on the long? The new Price Smart open location for Portmore 2022. Yeah. If you've been watching Mailpac, no, wait till that drops in in terms
because remember Mailpac, they were able to renegotiate terms for the existing contract with PriceSmart. So that's definitely an important point, Chike, because given that the history of their relationship, should the Mailpac secure a contract for additional PriceSmart locations, we're definitely going to see like an increase, or in theory, we would want to see an increase in revenues for that going forward. So I mean, you probably would have touched on this while I checked out. Mailpac is properly positioned to benefit from the acceleration for digital transformation that the pandemic has forced on us.
Yep.
So we're going to see more of a shift towards e-commerce. People convenience sells. So Mailpac is going to be able to link that gap between someone who's at home, they can't bother to go out, but they want to get grocery shopping done.
Exactly.
Mailpac can fill that gap for the person who wants to order clothes overseas. Mailpac can get that done. So they're definitely going to benefit from that. And as I said, we're moving much forward into the digital age, and e-commerce, that's definitely a sector that we should keep our eyes on
very closely. Very
yeah. I mean, for example, Amazon is not really the best comparison, like in terms of price multiples, because they operate in different regions. Amazon's a much bigger entity, but
bigger company, yeah.
Amazon, to show the market sentiment towards Amazon trades at a PE of around, I think the last time I checked, it was like 100 plus.
Yeah.
100, very high PE. That shows that there's high demand for the stock. Investors are pricing in the stock to stick around for years to come. So I mean, if that should be any reflection of our local e-commerce market, Mailpac can arguably warrant a PE that is trading at now, which is around 21 times. Who knows, it could be even higher. Because when you look at Mailpac's performance, year-to-date performance, profit is up 66.8% period over period. Revenue is up 41.8% period over period. And I mean, this compares to a growth rate of 25.2% for the 2019 financial year versus the 2018 financial year. So Mailpac is just growing much faster than it ever has based on all the information that we have. So I'm definitely watching Mailpac.
The environment favors them well. That is one thing I will definitely say. And as they put together more partnerships, for sure. I mean, I love their PriceSmart partnership, to be very honest. And if anybody looks on the outside of price of, or they take a look at PriceSmart itself, Jamaica's market in conjunction or combination, with the Dominican Republic market, they are the two best performing markets for PriceSmart now. And Jamaica does not have, in terms of, I think, square footage, the largest stores or the largest number of stores that are there. I think that is being held by people like Trinidad. They have more stores in Trinidad, etc. And yet we're pulling way more revenue. And then now we now have a proper relationship between Mailpac and PriceSmart. Yeah, it's just that knock-on effect that is just supposed to just bode well, going forward.
Definitely excited to see what they have in store for us going forward. I want to see how they'll do going forward.
Yeah. Well, my pick, jumping a bit over, goes into the food section. And it's a company we spoke about in the group a long time back, actually. But I've kept my eye on them, and their performance has caught my attention again, and that is Honeybun. Why do I say that? Because people might be looking and going, well, it's just the fact of the matter. What are we in? We're in a pandemic. People are looking for affordable prices on food. You have the kids at home. You need to give them snacks, etc., and so forth. You need to give them somewhat healthy snacks. And from what I know, in terms of how Honeybun does their stuff, and their products coming off of the shelf. So I mean, we've been looking at that. I've been looking at them for a while, and keeping close tabs on them. So going from the price section of Honeybun, their earnings yield projected right now is standing at 6%. They do their dividend. I mean, their dividends could be better. They've already started to pay a dividend for this year already, 2021, fresh out the blocks. We're already in January, and yet already being done, and their current dividend yield, as it stands, that has been put out, stands at a yield of 1.54%, right? So there we go. We have for the person who is the long-term investor, value investor, good company again in terms of the boxes, plus the PE. PE is not that bad as well. Based on where they're sitting, PE is currently at 16.5, right?
Yeah.
And their price to book is a little bit high. It's about three times the book value. So the actual book value per share, which is again the calculation on the financials of the company, it stands at $1.85. But I mean, with a earnings yield of 6%, and the fact that by the fact that the book value where it sits, it tells you who the company is. Now, when you get to the financial part about the company, I'm just going to bring that up because they're on junior market. One second. Honeybun, where did I put them? Junior market or main market? I think main market.
Honeybun would be the junior.
Junior market, yeah.
Yeah.
Oh, it's because I have a particular metric that I have open. That's why it wasn't coming up. 1 second. So Honeybun. And why am I looking at it? Well, let's start at the company financials. So again, they've done their financial year for the end of the year that ends in September. And for both 2019 and 2020, on all of the ratios for the thresholds that I'm using, Honeybun is completely green. They've got proper debt to asset ratios, proper debt to equity ratios, high cash ratio, quick ratio, current ratio. Their equity growth stands at 17%, right? I mean, they're ticking all the boxes on the balance sheet side. The equity growth, they've had some steady equity growth. 2018, 617 million. 2019, 740 million. 2020, 869 million in terms of shareholder equity, right? In terms of the asset growth, from 2018, it was 788 million. That went to 957 million, and now 2020 stands at $1 billion.
Yeah.
Right? Whereas at the same time, on the liability side, they started to bring it down. 2018, it was 170 million. 2019 went up slightly, 217 million, and then 2020 they brought it back down to 196. This is a solidly capitalized company on the balance sheet side. Flip it over to the. No, go ahead.
Yeah, it goes to show. I mean, I'm looking at the financial statements for the 2021 and 2019 financial year. You know, they've been actively monitoring their debt, because I'm seeing where you know, the long-term loans have come off from 21 million to 18 million. You'd have seen a slight increase in lease liabilities based on IFRS standard changes in the IFRS standard. But overall, like, you know, its long-term debt has mostly been static, moving from 49 million to 48%. So, I mean, while there has been growth in asset, they have been able to largely contain their liabilities. And Chika, I know that, you know, I'm probably one of the key factors why they have been improving their performance. I buy cinnamon roll every day. I love that. I mean, they have great products. I mean, from a consumer standpoint, the cinnamon roll, the donut, the coconut roll, they make excellent products. So I mean, it's a Jamaican company, and we've seen how our manufacturing companies have been operating amidst the pandemic. Honeybun is a clear example of the resilience of the manufacturing industry.
When you flip over on the actual and that part you're talking about now, in terms of how they've been managing the company, when you talk about revenue generation now, you start looking on how they've been handling gross profit. They haven't missed by any of my thresholds any year for their gross profit margin. It has stayed green. Their operating profit margin has also been up. So the gross profit margin for 2020 stands at about 47, 48, and the operating profit margin stands at 11%. That is decent. That is pretty high. When it comes now to the interest expense ratio, now as you talk about debt, moving from 2019 of 25.96, which by the way is extremely high, to a whopping 146.9. They are doing it. They are doing it. I mean, free cash flow. They had a little bit of a dip in comparison to 2019. It's dropped to about 6%, 6.3%, but that's still not bad because by the threshold I'm using, it's still positive. ROE, what you like to look on, still up in the high 90s, 19s. So it's 19% currently right now. I mean, a little bit dip from 2018, but still that means this is a free cash flow and return on equity, a high profitability company. I mean, yeah man, they stand to tick the boxes again for me personally.
Yeah, awesome companies. Actually, one of my favorites from a longer time. I've always liked Honeybun. I always liked. So you selected a manufacturing pick. I think the rest of I have strong confidence in the manufacturing industry.
Yep.
To touch on one that has basically displayed great efficiency and good revenue growth would definitely have to be Lasco Manufacturing. When I compare Lasco to like main competitors, their net margin is definitely it's one of the top ones. So over the last 5 financial years, your net margin has been averaging 11.6%.
Yep.
For the
Currently
year to date,
12.45 for their 2020 financial year.
Yeah, so it's they're actually operating at a for the 2020 financial year, they've been above the 5-year average. But if you actually look at the year-to-date period, so that would be the 6 months ended September 2020, their net margin is 18%. And I mean, that's a premium of almost 7%. So I mean, that shows that they're operating more efficiently than ever. So recently, what they would have done, they would have commissioned additional warehouse space for their liquid products, and they would have been in the process of commissioning even more warehouse space for their dry powdered products. So what we're going to see is that basically improved warehouse capacity is essentially going to result in lower admin expenses and gross expenses thereabout.
Very true.
So it shows that they're strongly committed to improving operational efficiencies and cost containment measures. For the year-to-date period, revenues have grown 7.2%, and its net profit has grown by 31%, period over period.
Yes.
So I mean, when you look at other ratios, such as the current ratio, it's very liquid at 3 times. Their return on equity is around 14%. Their expense to sales has actually moved down from 18.8% in 2019 to 16.2%. So I mean, this is just a company that is operating very efficiently, and it's a household name. Everybody knows Lasco. Lasco has a wide variety of products spanning from your iCool, your Lasco food drink, your milk, the ketchup, all of that. So it's a household name, and it's been around for a long time. It can be considered, one of the backbone companies of our economy, where they provide employment and so forth. So definitely one that I like to look out for. Lascem's PE is currently trading at a discount to its 5-year annual average, which has averaged 22.15 times, and it's also trading at a discount to key peers. So when I look at Lasco's PE of 14.5 times, this compares to the junior market manufacturing industry average of 21.6 times. So it shows that there's definitely some price appreciation that one might benefit from with Lascem going forward.
That's true. But I'll add to you sticking on the PE part. The earnings yield for Lascem currently stands at 7%. Right.
Yeah.
So I mean that is huge. And on the book value, I mean the book value, price to book value is a bit up there, 2.24 times, but still coming back with everything that we said. Actually, I'm surprised he didn't touch on this part. The gross profit margin and operating profit margin is through the roof. Gross profit margin for 2020 financial year was 37%. It's actually, I think this is the highest. The last time they did something like that was 2017.
So it's the highest. It's the highest for over the last 5 financial years. And
yes, that's right.
Year to date for 2020, their gross profit margin is 38.8%. So it's growing. It's heading straight to 39%. So that shows that L.E.A.R.N is very efficient.
And not to leave out the operating profit margin. They've never missed operating profit margin in terms of the thresholds I'm using. And their operating profit margin for 2020 was 16.4%. More importantly, they are covering their debt well. Their interest expense ratio for 2020 is 12, is a figure of 12.81. As a matter of fact, it has been steadily increasing for the last 5 years, since 2016, going for 4 years since 2016. So yeah, they're doing proper. I have to definitely agree, for sure.
Yes. To further add to the 16.4% for March 2020, I like to assess the year-to-date performance to see how well they are on track to beating the prior year performance. The operating margin of 16.3% for 2019 pales in comparison to a whopping 22.3% for the 2021 year-to-date period. So I mean, that shows that they're growing. Their EBITDA, the earnings before interest, taxation, depreciation, and amortization, is up 26% from 880 million year-to-date to 1.1 billion. When you're looking at how they're servicing their debt servicing capacity, as measured, through their interest coverage ratio, which is basically your earnings before interest and taxation divided by interest expense, they can cover their interest expense 26 times. So this is a company that basically, should it even want to raise debt, it should be able to do so very easily.
Comfortably.
It displays strong debt servicing capacity. So, should they have any growth, expansions, or support on their minds, they can raise the money easily.
They've also ticked the boxes as well too on the balance sheet side, in terms of the fact that their 2020 financial year was actually a really good year, where by the thresholds I'm using, their quick ratio, their debt to assets, their debt to equity, and their current ratio all went green for me. As a matter of fact, the last time they did that was 2012. So I'm not surprised in what you're telling me in terms of their performance now for the 2021 period. So they had already set this up in truth from ending of 2020. They're solid run.
It's a great company, and as I said, when I compare the net margin to other manufacturing companies, their net margin is much higher. So I mean, you want to probably kind of bear in mind that L.E.A.R.N's operations kind of don't reflect distribution, but what I'm saying is that we're mindful that it doesn't reflect distribution.
Yeah, sure. For mine, sticking on the same, staying still in the junior market as well too. One that I had been looking on for a while. I was actually invested in it, and then they disappointed me a bit. I'm gonna put that out there, because I thought that they would have done great things after they made their move. Was AMG Packaging. When they had gotten rid of the styrofoam part that was pulling them down, I thought that all of that money coming back into them would have made their operations a bit lean. It didn't materialize, but funnily enough, as it is for long-term investing, time is the master, and you must give value time to come up. So funnily enough, for their financial year, they dropped back on my radar. And as of August, their financial year ends in August. So for August 2020, everything for them went completely green. Debt to asset, debt to equity. They were basically keeping it or bringing it down. Their cash ratio went up very high. 2019, it was just 0.5. 2020, it went to 2. And their current ratio now stands at 3.6. I don't know what's going on, but good things seem to be on the horizon for AMG. So they're one to watch for me in terms of that's just on the balance sheet side. On the actual revenue generation profitability side, gross profit margin stands at 26% for August for their 2020 financial year versus 20%, 20.5% for the 2019 year, and their operating profit margin stands at 8.5 versus 8.4, 2019 to 2020. And then they are highly capitalized now with free cash flow at 7%. Actually, it's 8% because it's 7.889%. So call it 8%. The return on equity though could be better. That is at 10%. But still, I'm giving them time because they seem to be coming along and getting lean in that way. So I'm watching them closely. They're one. I had high hopes for them. So let's see what's going on with them.
Yeah, I mean, it's definitely one to watch. I mean, at a PE of 13 times, I'd want to watch and see if this company would be able to blow away the current investor sentiment, because if they're pricing the current price at 13 times, that shows that there's probably not much growth potential for AMG. So it's definitely something to look at, because I mean, they're operating in an essential space. There's always use for cardboard boxes and things like that, and there's always the opportunity for them to venture into other areas of packaging.
Yes.
Yeah, so like for example, the as an alternative to styrofoam and the plastic bags that we've been seeing, they could be properly positioned to utilize current technologies and machinery to develop additional or alternative plastic bags, alternatives to plastic bags as well as the styrofoam. So that's good.
Yeah.
Okay, so my last pick for the night would have to be Grace Kennedy.
Somebody just asked about it.
Yeah.
They asked about Yep. Let's go.
So, I mean, is Grace Kennedy, during the pandemic, one of the things that I like to look at and that I'm proud of is to see these stocks, when during the onslaught, when the pandemic had just started in March, there was a large sell-off, our market, crashed. There were circuit breakers after circuit breaker for key stocks, and our market dipped as much as, I think, 27 to 30%. So when you see that, a decline, like a 30% decline in our overall market, yet Grace Kennedy has been blowing away its performance period over period. We're seeing double-digit growth in most segments. Let's look at the looking at from a segment standpoint. When I look at the year-to-date performance of food and beverage, which is basically that's where they generate most of their revenues. Revenues for the food and beverage segment grew from 61 billion to 67. So we're seeing year-over-year growth of period-over-period growth of 11.8%. When we look at the company's insurance segment, it's grown from 5.5 billion to 7 billion. That's period-over-period growth of 27.6%. And then when we look at money services, which is where they would generate most of their profits, that segment's revenues has been growing. It moved from 5.8 billion to 6.4 billion. So that's a period-over-period growth of 11.9%. When we go ahead and look at the profit before taxation, food and beverage profits has grown by 86% period over period. Insurance has grown 10% period over period, and money services has grown 28% period over period. So I mean, when you see performance like this during the pandemic, it just goes to show that Grace Kennedy, one of the other backbone companies of our economy, it's perfectly demonstrating the resilience of the manufacturing industry. For the longest while, as an investor, I've been assessing the Grace Kennedy Q, and I realized that one of the things that basically hindered price appreciation, or that the stock was mostly trading at around 57 or 58 level. When I look at the Q, and as an investor, I'm turned off when I see 2 million shares being offered for sale. So I believe that the reason why Grace stock price didn't perform as good as one would have wanted it to in 2020 was basically because of that supply of stock for sale. So from a technical standpoint, that 58 level would have basically you could consider it as resistance because the price wasn't going beyond that price level. But basically what we saw was that basically once that 58 order for 2 million units or 1 million units thereabout. Remember, 1 million units, $58 million worth of GK shares for sale. Once that was settled, instantly we saw the stock price trade to as high as $65 at the time. If we fast forward today, the stock trade as high as 70 today.
Oh yeah, that's right. 70 point. Today's high was 70.1.
Yeah, today's high was around 70. And I mean, even at a price of 70. Let's look at the PE at a price of 70.
Oh, I was waiting for you to get to that. Everything about them in terms not just PE but price to book is sweet. Their PE is down at 12 as of today, 12.1. The price to book is only 1.2 times over, which gives them a nice margin of safety for me of 14.68. And the threshold, as I said to everybody, was anything at or below 22.5. Even more so, their earnings yield potential is at 8.24%. Come on, I mean, yeah,
It's a great stock. I mean, it's a blue chip stock. So I mean, there's some level of comfort knowing that this is a well capitalized company. It's been around for years. It pays dividends. So I mean, it's a safe bet. So in addition to
it's value. It's value.
Value. It's basically just value for your money. So from a value investment standpoint, it's definitely a good pick. And I'm eager to see, the plans that they would have in place because I mean they would have recently started a mergers and acquisition unit. So that basically shows that they're actively seeking merger and acquisition opportunities. So what this suggests is that while revenues have been growing organically through increased market share and so forth, they're also seeking to also grow revenues inorganically through mergers and acquisitions and thus, giving great value to investors. So it's definitely one of my top stocks that I want to see how they're going to perform for the 2021 year.
Yeah. Well, I expect good things for them. In all sectors because of just how the company is managed. So for sure, most definitely to keep an eye. But again, as a value company, on the metric side, they are currently at the price, funnily enough, of their last traded price of 67 is still currently undervalued for a value company like them. So they got a good way to go.
Yeah. So I mean, they're trading below their 5-year average PE. They're trading below key peers. And basically, you want to do your due diligence when you're buying a stock. So I mean, when you look at the key profitability ratios, the solvency ratios, they basically pass all of that. They've been passing it for years. They've always been able to service debt. They've always been properly capitalized. Margins have always been, improving and good and so forth. So it's definitely a value company at this point in time.
Yeah, most def. Well, for mine, I've got a dark horse. My own is not value. It's growth, and the choice that I picked for mine is Indies Pharmaceutical as my final company. So maybe the record might have scratched there out in social media land, going, "What did you just pick?" But I'm going to say why. So for Indies Pharmaceutical, and I am, in my view, bullish on this company. I've liked how they've been managed. I've liked how they have performed. The most recent thing that Indies did was capitalize themselves in the form of a bond. And then they paid the bond off in quick succession. Now, something I've noticed about Indies as they've been going on in terms of their management, they don't really like to keep debt, outside debt, for too long. What does that mean? If it's not around the parent company that holds them, which is Biopress Holdings, they try to pay that off as quickly as possible or keep it very low. So what you find is from a financial standpoint, Indies is heavily capitalized. And Indies for the last 3 years had a excellent debt to asset ratio by my threshold on the balance sheet side, debt to equity, debt to earnings before taxes and depreciation. They had a high quick ratio. They had a high cash ratio for 2 years consecutively running 2018 and 2019. And what did they do? They went out and bought and got additional space so that they could do expansion in Jamaica. And what did that do? That impacted their 2020 financial year, which is expected because they're now putting their capital to work. Additionally, they also made a move into trying to get their drugs approved in the United States, and they currently have their patent, their drugs on the approval block for the FDA. So for me personally, going forward, and given the fact that their drugs deal specifically with hypertension, etc., and what do we know is one of the major things that plagues the United States? It's a perfect shoe fitting for a generic drug if they get it off the ground. So additionally too, another qualitative thing, and this is not quantity as yet, qualitative is the fact that their parent company, BioPress Holdings, has its entire lab, factory, etc. in India. We are currently in a pandemic. And what happened when the pandemic set in? We saw industries that weren't doing certain things pivot. So in the United States, you had GM and Ford and every one of them who make cars pivoting to basically try and make ventilators. I have this, I would like to see it out there, so I'm putting it out into the universe of my thought process. So the fact that the government has recently entered into having discussions about the vaccine from India and from Cuba, etc. And I'm just sneakingly saying, we don't know what is going on in the background, but this is a pharmaceutical company that has direct ties to a big company in India with a lab, with a manufacturing plant and everything like that. Are there possibilities? Are there possibilities that they could be working very closely, right? Because their drugs are offered by the government under the NHF and so forth. So who knows? But then that's just the qualitative side. When you get to the quantitative side of Indies, as I said, the company is run very good. I mean, they basically, for the financials, as I said, for the balance sheet side, really well, they put their money to work. For the profitability side, gross profit margin since Indies has come to market and prior has not dropped below 60%. Their gross profit margin for 2020 was 68%. And their operating profit margin has steadily grown from 2013 of 5% to now stand at 25% for their 2020 year. They do what is required to run a proper shop. Their interest expense ratio as well too is their 8 times, so they can pay it 8 times if they needed to deal with their debt, which, as I just said, they don't like to keep outside. From what I've observed, don't like to keep outside debt for too long. They rather keep it close to either the parent or something else. Another thing to look at qualitatively, we must not discount the people that they've added to their board as of recently in terms of their directors, etc. Those are lean, mean guys who basically deal with looking for the best investments and the best ROIs. So most definitely, there is stuff to watch about Indies, because their ROE currently, by the way, stands at 25%. So equity return is 25% as of 2020. I mean, and that is up from 19.4 in 2019. So and don't, let's not even, if we go over to the PEs and the book value now, I mean, let us not discount the fact that Indies paid a dividend last year and their dividend was 5.28%.
Yeah, I remember. You know, one thing with Indies that they generate like a lot of, they've been generating a lot of cash from operating activities, and we've seen their EBITDA, the EBITDA have been growing like around, year to date, it's around like 50%. So basically, because they've been able to generate so much cash from operations and so forth, investors have been able to enjoy that sweet dividend that they paid recently. I think the yield was around, what was the yield? Around 5
So
there?
the yield was 5.78% was the yield. and their current earnings yield stands at 5.43%. I mean, their P ratio is by the threshold I'm using is a bit high, 18. They fall in what do they fall in the let's see, is it the money? What would it be? Let's just see in these, and they fall in the retail sector. And the retail sector at 18, average P retail sector 16. So it's a bit high. It's a bit up there for them, but still the growth prospects and the fact that if they could pay that same or close to that same dividend again this year, and the fact of if that FDA approval now with the change in the United States comes on board for them, and also the expanded warehouse space starts to work for them, don't discount what could be coming out of their 2021 financial year.
Yeah, it will be very exciting to see if they are able to cap into that multi-billion-dollar pharmaceutical U.S. industry. You know, I mean, to even get less than a percentage share of that would definitely do good to their income statement.
Yep. So that's it.
There you have it, guys. Those are stocks that we're actively looking at. Please be guided that this is not financial recommendation.
Yes.
Observe.
Say it again.
Yeah, not financial or buy recommendations.
At all.
Only for educational purposes.
Yeah. So I actually like a lot of those picks you guys have shared. I have a few that you've mentioned that I'm watching as well. So we'll measure it and see how the year goes. I actually really like the only company that probably we're talking about in the group that we haven't mentioned here is Lumbo.
That's one of the also runs.
I've been holding Lumbo since they gave shares from Blue Power. So I had some Blue Power, got some Lumbo. So for me, Lumbo is all free. So I'm just kind of holding, chilling.
That's good.
So in terms of that question that Claudette has, you can go to moneymax.com. They should have an outline of the dividend paying stocks, how much dividend they have paid maybe in the last 6 months or a year for each company. Stephen, if you're watching, just let us know exactly where we can go to get that information, but definitely check out moneymax101.com, Claudette, for that. So I was saying, apart from Lumbo, I'm looking at Carib Cement as well. I like Mailpac, but I'm actually more long-term on Mailpac, so I'm trying to find the best price. Like, it's not, I'm not trying to trade it per se. I think it's a good option for dividend. I personally don't trade because I don't have the time. So if I try to get in for like 2 months and I buy it, I'm not confident with the time that I have to invest that I'll be able to get the target price I'm hoping for. But as I was saying to somebody in the chat earlier, you can use this information we're sharing for your own purposes. Just bear in mind that we're not telling you what to do. We're just sharing the information, analyzing it, saying what we like, and it's for you to determine how to use that information to best suit your needs. So apart from that, I'm looking really to see which companies can pivot during COVID, manage and still, realize some amount of growth. I really think, I thought at least that we'd be seeing some more kind of, I'm waiting to see whether or not certain sectors pick back up. But those ones that I mentioned are the ones I'm watching. Carib Cement, Lumbo. I like indies as well, definitely. As Shika mentioned, I'm actually, I've been in indies for a little bit, watching that to see how that goes. I like to pick companies that are unique, meaning if they're not, if there's only one of that type or maybe two or three of that type at the most, those are the companies that I look for.
Yeah.
So I'm trying to consolidate. I have a couple of financial stocks, and so I'm like, well, if I have so many and they're all pretty much not doing so well right now, just kind of shift all of my position to one or two, and then that means when we come out of this pullback, I'll be in an even better position because I have more volume in the one I want. Take that for what it is. That's kind of my investment strategy. But yeah, so guys, thank you. I don't know if you have any final thoughts that you want to kind of close out the session with.
I'll let Andrew go.
Okay, final thoughts. Yeah, guys. So I mean, it's great to have your listing of stocks that your top picks. So essentially, what's a great strategy is to ensure that you look for the dips. So you buy on the dips and you sell where it's been overpriced. And that's basically it. Look out for the dips, look out for bargains now, because we're still the overall index hasn't really recovered to pre-COVID pandemic levels as yet. It's still moving at its own pace. We'll be patient. So as such, there's still opportunities to buy stocks. You have some investors who probably want to switch, the asset. They want to move out of equities and just hold cash, or they want to go to bonds and money market instruments. As such, they're exiting equity positions. Our market is not liquid, so sometimes they do it at some bargain prices. So if you have a key stock that you like, you just study the trend and you just pay attention to the dips, and you're buying on the low prices and get some good prices, guys.
Yeah. So it definitely depends. I would say if you're holding your portfolio since before COVID, it's an excellent time to average down on some of those stocks you're holding. I know the strategy to kind of hold it and wait till things pick back up. But what I always say to the group, if you don't have a good reason to sell a stock, then you should be able to buy more. So just kind of average down. If you're at a 30% loss and you add to that position, you've decreased that loss to maybe 15 or 10%. Exactly. So that's what people don't understand. You can actually diminish those losses by adding to your position. It's kind of counter-cultural in terms of investing, though, because we kind of feel like if a stock is low, it will go lower. And then inversely, we feel like when it's going up, it will always go higher, which is not true. So you have to kind of understand that just kind of employ the right strategy depending on what the market is giving you, based on what your own personal goals and preferences are.
Agreed.
So my own is going to take a broader view. As was said before, I'm going to tell everybody out there for everything that we've said tonight and everything that you'll take afterwards from whomever you will hear it from, and even from your financial advisors as well too. You need to do your homework. So you've got to get better. If you don't want to do the work, it is best you just let your financial advisor invest your money for you, or you put your money in one of the mutual funds. Unit trust, right? Because we don't. So one of those unit trusts, and let them manage that for you. If you don't want to do the work, but if you want to do the work, you're gonna have to do the homework of taking that view. And additionally, what I'd say is, as Andre touched on it, in terms of we're not anywhere out of the woods yet, but if you're an investor, it means that you need to be paying, especially investing in Jamaica, you need to be paying keen attention to the news and what the government is saying, especially the finance minister, in terms of where Jamaica is expected to be heading. That gives you a pretty good indication of what industries stand to gain, and by extension, when you look at also what the government is saying, you see where they're going to be putting their focus. So for instance, like agriculture and manufacturing, so note the companies that we were talking about tonight, you can basically take a view to look and see, well, based on what the government is doing, Will these stand to gain further on down the road? So you take that broad, you've got to take the broad view of everything when you do investing. Investing is not just about picking the stock alone and all of the ratios and the indicators that we spoke about tonight. It is about both a quantitative, which is the numbers that we give, and a qualitative side, which also encompasses the economic factors that influence the companies. And then in general, investing is not just about companies alone, as again both Jermaine and Andre touched on. You have other forms of investing, such as bonds and government paper. If you're there are other markets as well too. There is not just the Jamaican market as well. Do your reading, do your research. It's fun. Just start listening to the financial news a lot more. Then you'll simply pick up those terminologies, that you're asking questions to. And also, investopedia.com is your best friend. So if you need to find out about any terminology that we've used tonight, investopedia.com will
Investopedia.
And you can look on our videos as well.
Yeah, and typically we don't use terms here that we haven't explained in another video. So
yeah,
the video from Andre on trading strategies, excellent starting point video. Video from GK on how to invest like a value investor, excellent video. Video that I did on investor profiles. I would watch all 3 videos before I make an investment decision if I'm a brand new investor, because those 3 will help you kind of have the right perspective, because we can never say whether or not a stock is a good pick or a bad pick, because it depends on how long you're holding it for, the price you paid for it, your personal outlook on that company, all of that stuff. So, use that to weigh into your decisions. But want to thank everyone that has stuck with us from the start, and for those who joined halfway, we really, really appreciate it. Please don't leave until you like this video. We need you to like it so that YouTube will show it to more people. Please share the video with at least 10 persons. So 40 persons here, share it with 10 persons each. We would really, really appreciate it. And just share what you've been learning. Tell us in the comments below the video, after, beneath the live chat, what you've gotten from this. Tell us your picks. Tell us everything that you've been learning and kind of looking at in the market, and let us learn from you. Share anything that you think would be of value to the community. And we will be back next week when we meet with Jillian Jackson, talking about financial freedom. Yeah, you definitely don't want to miss that one. So that's next week, Wednesday. GK will be back soon, sometime in February, and I think we'll see Andre soon as well. So thank you guys very, very, very much. And yeah, take care, guys.
All right, guys, take care.
Take care.